This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Well, hello and a very happy belated Thanksgiving to you. I'm Greg Smith, Senior Financial Planner with the Wise Investor Group, and it is a pleasure to be here with you today. It is Saturday, the 29th of November, the Saturday after what I hope was a lovely Thanksgiving holiday for you and your family. Hope you got all the turkey, the stuffing, and football that you wanted, and then some. And I hope you got a good and meaningful nap in there after enjoying all that turkey. And the reason that I'm hopeful you got your nap in already is because I don't want you sleeping on the ideas that I'm going to be mentioning on today's show, because waiting until mid-December could very well be too late. The ideas I have for you on today's Wise Investor Show have a very limited shelf life, as they involve lowering your taxable income for this year and potentially increasing your deductions. So you need to prepare to act and act soon if you're going to do it. Of course, now that I've said this, I do need to tell you that the ideas that I have for you today are just my ideas and observations. So by all means, check out anything I say today with your tax preparer, your attorney, or your financial advisor before implementing. And now that I've said that, let's get to it. What are the action items you need to be considering within these next couple of weeks? Well, for this year, there are a lot more moving parts when it comes to your tax situation than there have been in recent memory. There are new deductions hitting the scene and all kinds of new income phase-outs to be aware of. So the first thing I'm going to recommend is that you reach out to your tax preparer to make contact and see if you can identify what your potential income will be for this year. Knowing that, or at least being in the ballpark, preferably being closer to the infield of the ballpark, will be helpful to you and your tax preparer. You'll want to take into consideration all of the earned income you've generated from your salary and bonus if you get one, and of course your interest income, dividend income, and realized capital gains for the year. Being in contact with your tax preparer and seeking to identify what it is you're looking at for the year as far as your gross income goes will be extremely helpful in identifying next steps. Because once you know what it is you're looking at as far as your gross income goes for the year, by working with your tax preparer, it will help to inform decision-making on other opportunities you might have in front of you. And by the way, if you haven't already, you might catch up a little bit more on what I'm talking about today by listening or re-listening to my partner Matt Anderson's Wise Investor Show from October 18th to learn more about the subject. And as we're approaching the end of the year, if you're subject to required minimum distributions, you're going to want to make sure that you've taken your required minimum distribution for the year. And if you haven't yet, and you're charitably inclined, you're going to want to make use of the qualified charitable distribution, and you're going to want to get it done very, very soon if you haven't done them already. Qualified charitable distributions, or QCDs, as they're known in industry parlance, are wonderful things. They help out your favorite charities and your tax situation all at the same time. They allow you to send money out of your IRA to charity that both applies towards satisfying your required minimum distribution and it does not count as income taxable income in the first place. Therefore, up to a limit this year of $108,000, if you have a large enough required minimum distribution, could come out of your IRA tax-free and count towards satisfying your required minimum distribution if you make use of that QCD maneuver. But here's why I mentioned that you can't sleep on this and that you really need to get it done soon if you haven't already. A very nasty thing happens if your QCD check isn't cashed by the charity before the end of the year. If you wait too long on taking advantage of the QCD, and the charity doesn't cash that check before the end of the year, then as far as the IRS is concerned, the money never went out of your IRA, your required minimum distribution wasn't met, And you could be on the hook for paying penalties on what should have come out but didn't. Therefore, I'll tell you that the QCD is a great way to reduce your taxable income, but it's something that you can't wait too long to complete. That's why we typically recommend that they all get done by Halloween. By the way, I should mention that if you have any questions about anything I'm covering on today's show, feel free to reach out to me anytime at gregory.s, as in Sam, .smith at raymondjames.com. That's gregory.s.smith at raymondjames.com. Of course, I'll be happy to get back to you. We're talking today about action items you should not sleep on completing, things that you really should start doing now if you haven't already done them. If you own mutual funds in your after-tax accounts, pay attention to their communications about year-end capital gains distributions. One of the things I like about our investment management for our clients is that there really aren't any surprises from a realized capital gains perspective at the end of the year. You can pretty much know all year long what you're looking at from a realized gains perspective. With mutual funds, there could be a large capital gain that's distributed at the end of the year to shareholders of record, or not, depending on the year and what went on within those mutual funds. So if you own mutual funds, start getting ready to identify whether your mutual funds are paying out large capital gains distributions in December, and add that to the income that you're expecting, because all income from all sources will be a factor in some of these extra deductions that you can take for this year. Depending on what you paid for those mutual fund shares, you might discuss with us or your tax advisor the wisdom of keeping or selling some or all of those mutual fund shares before they distribute out that capital gains distribution, should that be happening this year. So you're going to want to stay on top of that. One of the big reasons that I mentioned watching your income and staying on top of it for this year, especially, and being in close contact with your tax preparer, is because it would be good for you to know how close you are to being able to take advantage of a couple of potential deductions that you might be able to avail yourself of this year. There are a couple of new potential deductions that I'm going to be focusing on for this podcast. Number one, if you happen to be a person of, shall we say, experience and are above our age 65 or beyond, then you could have possibly an additional $6,000 tax deduction. And if you're married to another person who is also 65 years or beyond, then you each could get that extra $6,000 deduction for a total of $12,000 additional beyond the standard deduction or your itemized deductions. However, this is why you need to watch your income. If you're filing single, and if your income is beyond $75,000, well, then you start to get phased out of that extra $6,000 deduction. And then filing single, once you're at $175,000 of income, you're fully phased out and you don't get that extra $6,000 deduction. For folks filing married, filing jointly, if your combined income is under $150,000, then you each get that $6,000 deduction on top of the standard deduction. And then once your income is beyond the $150,000 income level, you're subject to being phased out of that deduction, such that once your income reaches $250,000 or beyond, you don't get any of that extra $6,000 deduction per person. This is why it's going to be important to know what kind of income you're looking at for the year, and why it's so important to be in good touch with your tax preparer. Here's another reason why you need to have a good idea of your income for this year. The SALT limit, or the deduction limit on the amount of state and local taxes, along with your property taxes that you paid for this year. That's potentially increasing from $10,000 all the way up to $40,000. That's a big jump in potential deductions. So here's what you need to know in order to determine if you're going to be able to deduct your state and local income taxes that you paid along with your property taxes up to a limit of $40,000 starting this year. It's that your income has to be below $500,000, whether filing single or married filing jointly, oddly. It's a bit of an odd dislocation there. Whether you file married filing jointly, whether you file single, if your income is below $500,000 and you've paid $40,000 or more in state, local property taxes combined, then you get to deduct all $40,000. And if your income was close to being around the vicinity of being able to qualify for that larger deduction, well, you'd probably want to take steps to put yourself in the best possible position to qualify for it. If your income is beyond $500,000, $500,000, you get fully phased out at $600,000 worth of income, and your SALT deduction goes back to the $10,000 floor. Another reason why it's important to have an idea of how much income you're looking at for the year. You're going to want to avoid what's known as the SALT torpedo, where your income is beyond $500,000 but less than $600,000, where you're losing deductions and paying more in income tax for a double whammy to the bad. Now, when I come back from the break, I'm going to tell you what you can do to seek to avoid the SALT torpedo and to try and avail yourselves of these deductions. You're listening to Greg Smith, Senior Financial Planner with the Wise Investor Group of Raymond James, and I'll be right back.
AI stocks still dominate the market, but valuations are almost back to dot-com bubble levels. How should you balance participation with diversification? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at RaymondJames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Thank you, and welcome back to the Wise Investors Show. I am your host for today, Greg Smith, Senior Financial Planner with the Wise Investor Group of Raymond James, and it is certainly a pleasure to be here with you today. Well, today I'm talking about things that you pretty well need to get on top of very soon if you haven't already, to put you and your family in the best possible position for maximizing some of the enhanced deductions that might be available to you for this year. We've talked about making use of the qualified charitable distribution, the QCD, if you're subject to required minimum distributions, and making sure they're done already or getting done really soon, as the charity absolutely has to cash that check before the end of the year for the QCD to work as intended. We're also talking about some of the new deductions that are available to you starting this year, such as the extra $6,000 deduction per person, as well as the increase in the SALT limit deduction from $10,000 to $40,000. But the trick is that you have to watch your income and be under certain thresholds. To qualify for the extra $6,000 deduction, your income needs to be below $75,000 if you file single, and $150,000 if you file married filing jointly. For the increased SALT tax deduction, your income needs to be below $500,000, whether you file single or married filing jointly. Oddly, it's the same income limit. There are other potential deductions, too. There could be up to a $25,000 deduction on income if you receive tips. And there could be deductions for overtime pay up to $12,500 filing single, or $25,000 for joint income and compensation beyond regular pay. You might be able to deduct up to $10,000 for interest on your car loan, with quite a number of limitations and restrictions. And you also get an above-the-line deduction for cash charitable donations of up to $1,000 if you file single, and $2,000 if you contribute $2,000 to charity in cash and you file married, filing jointly. So here's why it's so important that you're in contact with your tax preparer to have an idea of where you are from an income perspective. And it's because there may be some things you can do to seek to reduce your gross income, to try to get more of those deductions if you're close to being able to qualify for them. The first thing that comes to mind for me is making lemonade out of lemons. That's taking losses in your taxable account if you have them. Now, I know it's no fun to take losses. However, please bear in mind that any losses you take will offset any gains you've realized, and that will be a dollar-for-dollar reduction in gross income that you're seeking to decrease to attempt to get you better positioned to qualify for new, potentially available deductions. Realizing capital losses reduces your capital gains, which reduces your adjusted gross income, the amount of income that those phase-outs are based on. This is where losses could really be helpful to you. They not only reduce your income, which reduces your tax, but also they help you qualify for more deductions at the same time. So that's a double positive for you. And now that's a tax torpedo that you're firing. And I would also say, watch those capital gains distributions on any mutual funds that you hold in taxable accounts and let your tax preparer know what it is you're looking at as far as those extra unexpected taxable income figures go. Also, please let us know if you want to talk about those because we might have some ideas for efficient ways to get you out of mutual funds in taxable accounts. It might be nice for you to not have to deal with capital gains distributions at the end of the year going forward. So if you care to discuss that, please do reach out at gregory.s.smith@raymondjames.com. Other ways to reduce your income for the year include making sure that you've fully funded your HSA, your health savings account, if you have one. If you're single, the limit is $4,300. And if you're married and have family coverage, your HSA limit is $8,550 for this year, $8,550. You also get an extra $1,000 of contribution limit if you're age 55 and beyond. This is an easy way to get your taxable income reduced while being able to invest and later on distribute out money tax-free for medical expenses, including offsetting your Medicare Part B premium once you start paying for them. So if you have access to an HSA, please make sure you're making full use of it if you can. That really helps. Another way to reduce your taxable income is to fully fund your 401k, 403b, SEP IRA, or other company retirement plan. Once again, if you're on the cusp of qualifying for some of these deductions and you aren't fully funding your company retirement plans, well then by making sure you're making full use of your company retirement plan, not only are you reducing your income for income tax purposes, your company might offer a match, which provides then extra free money on top of your contribution, and you might be positioning yourself to better qualify for these other extra deductions that you might not otherwise have qualified for. So in my eyes, that's a triple win. Or in my family, since I have 3 young hockey players, that's a taxes hat trick for you, which is almost better than a Texas hat trick, which is 4 goals in a game. But a taxes hat trick allows you to reduce your taxes, get additional free money in the form of an employer match if it's offered, and potentially get you positioned for what could be a greater deduction if you're close to qualifying for it. Asking your tax preparer if you qualify for an IRA deduction can also help, as those are above-the-line deductions if you qualify for them. The $7,000 limit for this year, or $8,000 if you're age 50 or beyond, is a contribution limit that is independent of your 401k limit and your HSA limit. So if you have the means to be able to contribute to your 401k or company retirement plan, your HSA, your health savings account, and your IRA, if you qualify for the deduction, you're doing just about everything you can from a contribution standpoint to reduce your taxable income. If you're making use of the qualified charitable distribution, and please very soon if not already, and you're recognizing losses to seek to offset some of the gains you've recognized this year, that'll be helpful as well. And if you make cash gifts to charity, you're able to take an above-the-line deduction of up to $1,000 or $2,000 depending on how you file. If you're doing all those things that I mentioned in concert with staying close with your tax preparer to find out if you're close to qualifying for these deductions, then you're doing just about everything you can to try to keep your taxable income in check and will have put yourself and your family in the best position possible to try to take advantage of some of these new deductions that have become available to you this year. It's been great being with you here today, and I hope it's been helpful for you. If you have any questions about anything I covered today, please feel free to reach out to me anytime at gregory.s.smith@raymondjames.com, and I will be sure to get back to you. My partner, Simon Hamilton, will be hosting next week's show to bring you our latest observations and ideas. And until then, I'm Greg Smith, financial planner with the Wise Investor Group of Raymond James, and I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.